Hi, everyone. This is Brad Dombrowski with First National Bank in the Mortgage Division. I wanted to thank you for joining me today for my first installment of All Things Personal Finance. Today, I'm going to talk a little bit about understanding your credit scores. At the end, hopefully some of you that are watching will have some questions. We'll go through some comments. The idea is to do this every month. I'll try to do it on good topics that I think are of importance. I also plan, when I can, to put some postings down below on the information that I'm covering. If I have some technical difficulties, I will post them afterwards so that we can make sure that all of your information is answered. The first thing that I want to talk about is, why is a credit score important? A credit score is really a grade for how you pay your bills. People that use your credit score will be things like credit cards, getting auto loans. As you may not know it, your car insurance is actually going to look at your credit. So it's really important that you have great credit whenever possible. And so today I'm going to explain things that you could do to make sure that you have good credit and really what's built into your credit score to hopefully make your opportunity to get financing in the future pretty simple. So the first thing that I want to talk about is, what is the range of a credit score? And if you give me just a moment, I'm going to actually post right here on my Facebook page what we're going to cover. And as you may or may not know, credit scores range from a 300 to an 850. Typically, you'd like to be above a 740 credit score. That gets you the best of the best. As you go down in increments, typically the lower your credit score, you're considered a higher risk, which would in turn mean your interest rate provided may be higher, whether that's credit card offers, car loan offers, really anyone that's trying to give you credit that you're applying for, that credit score is going to dictate what interest rate you are offered. And again, a 740 and above is kind of the golden number. Being above it is great, but honestly, in the mortgage world, if you're a 740 or an 850, you're going to get the same deal. So 740 is kind of the number that we're trying to do. I'm going to see if I could post this on here right now. And let's see if it's going to let me put a comment. So the first thing that I want to show you is what is built into your credit score. So what's built into your credit score is it goes from a 740 all the way down to a 350. And essentially the grade levels are, and I'll put this in the comments below, anything between a 720 and a 740 by a grade standpoint is about an A+. If you are if you're from a 680 to a 720, that's about a B+. If you're from a 620 to a 660, that's about a C. And from a 580 to a 620, that's anywhere from between a C and a D. So trying to put these scores into kind of simple understanding, that's kind of where your grade would be. And the lower the grade, unfortunately, the higher the interest rate that you would be offered. And that's hopefully assuming that you'd be able to get credit. So now I'm going to post this. Hi, Kit. Thanks for joining us today. Let me post this. Hopefully will help you guys a little bit covering this. It's my first one, so bear with me if I'm having any technical difficulties. It doesn't look like it's going to let me post my slides, so I'll show them afterwards. So what's in a credit score? The first thing that I will tell you is that 35% of credit scores are based on your payment history. So the number one thing that you could do to make sure that you have good credit is pay your bills on time. Being late could sometimes have a really big impact on your credit scores. So the number of accounts paid as agreed, the number of delinquencies, and also previously bankruptcies or judgments. And 35% of your weighted score is based on this information. So again, in a perfect world, as I tell my clients, do everything that you can to make sure that you're paying your bills on time, because 35% of your scores are accumulated from paying your bills on time. The next portion of your credit score calculation is the amount owed on your credit. And 30% of the score calculation is from amount owed. Now, what's important about amount owed is, what do you owe versus what is your limit? So if you have a $500 balance, but your limit is only $700, that may appear to a creditor as if that's close to being maxed out, and that may negatively impact your credit. If you have a $500 balance, but your limit is, let's say, $5,000, that would be probably okay because that's a very low credit utilization. So in a perfect world, you want to try to keep your credit balances about 30 to 40% of the limits. Some folks like to go and call the creditors and see if they can get a bigger limit. But in a perfect world, 30 to 40% of your limit, you want to keep your balances around there. And again, 30% of your scores are based on this. So you want to do your best to try to keep it there. Thanks for everybody joining us today. The next bracket of your credit scores is the length of your history. So obviously when you're younger, it is what it is. You need to wait for time until your credit starts to build up. But actually 15% of your credit score calculation is based on the length of your accounts. So in a perfect world, you don't want to go out and apply for a lot of new debt in a compressed period of time, because the more debt you have that is very new accounts, that could send a potential red flag saying, hey, there's a lot of new debt coming, and the credit scores aren't really showing that. So scores typically will be a little bit lower if your credit balances are very little history to them. So if you have an old account and you don't use it a lot, I wouldn't suggest closing it. I usually tell my clients, use it to buy groceries every once in a while, use it to fill up the gas tank, pay it off every month. You don't have to pay interest, but keep those old accounts going. Now with the caveat of they're hopefully not charging you an annual fee. You should never have a credit card that charges an annual fee unless there's some perks behind the scenes that kind of are making up for that. So again, make sure you keep your accounts as old as you possibly can. Keep those old accounts open. The next 10% bracket of where your scores are going to be based off is the new credit. So again, as I said before, typically when I'm pre-approving folks and they want to go out and buy a new house and they want to go to maybe Furniture Mart or any of these department stores and start buying things for their home, I will always recommend to not do that until after the home is closed, because your credit in the short term could be impacted negatively by new credit. So obviously the whole point of credit is to get more credit as you need it. So just use your best judgment when applying for new credit, that the timing of it may not jeopardize something else larger that you're trying to do. And then the last bracket, or the pie if you will, and I'll put these slides in at the end, is the final 10% of your scores is based on the type of credit. So when we speak about type of credit, we're talking about mortgage, or is it an auto loan, or student loan, or department store credit. Believe it or not, mortgage debt's not necessarily terrible for your credit because it's a long installment period. So it allows you to build up your credit history. Sometimes revolving credit is not the best, because you may get a new credit card at a department store and they give you a limit of, let's say, $10,000. Technically, you can go out and use all of that tomorrow. And so the type of accounts is important. And again, those type of accounts would be things like revolving or installment, cars, mortgages, credit cards that you may get at your department stores. So again, I'll put these slides in the comments below. I would welcome you to please look at those. There's again 5 items in kind of the pie chart that determines what your scores are. And credit scores are super vital to getting great interest rates, no matter what you're trying to purchase. Also getting, maybe if you are still a renter, that the landlord will probably check your credit. Again, if you need car insurance, most car insurance companies will check your credit, because that does show the ability to make your payments on time. So hopefully this information is helpful. Now, the last thing I want to leave you with before we go through and see if anybody has any questions is, what can you do to fix up your credit? So I'm going to read a couple of things here. As we said before, if you can avoid having maxed out credits, that's a no-brainer. But do your best. If you have a situation where your limits are your balances are higher than you want, call your creditor. See if they'll give you a larger limit, not to spend more, but so that at least you have a little bit more wiggle room so that your credit may not be impacted. Avoid a lot of inquiries in a very compressed period of time. If you, in a short period of time, you don't want to go out and buy a house and then go buy a car and then go get a Best Buy card or a Furniture Mart or department stores, really the lot of debt you get in a small period of time may have a negative impact. So be careful with that. Check your credit from time to time. There's a lot of apps out there. Credit Karma is one of the more popular ones that I see. You can go to annualcreditreport.com for a free copy of your credit report every year. I highly encourage you to check your credit on an annual basis to make sure that, number one, you know what's out there, there's no fraud, but also just to see what lenders may be seeing when you're trying to apply for credit. Again, keep in mind when you do pay your balances, it may take a month or so for your scores to be reflected from that. Again, don't close out your older revolving accounts, as we talked about earlier. And then lastly, please, if you can, at all expense, make your payments on time. That will have the biggest impact to your credit. So that's all I wanted to share with you today. I'm going to see if I can figure out how to go through the comments, see if anybody has any questions, And let's see what we've got here. I've got a question of how long after a charge-off can you buy a house? Thanks for that question, Kit. Actually, that's a little bit more of an in-depth question because that's not sensitive as much to your credit score as it is to the loan product that you're getting, and we will discuss that in future calls. But I will tell you, when it comes to having a charge-off on your house, we're talking about credit reports today. The minimum credit score is a 620. With First National Bank and majority of all lenders out there, if you wanted to do a conventional loan or a VA loan or even an FHA loan, it's typically a 620. As your credit score drops below that, it becomes very challenging to get a mortgage and maybe some other loan products as well. Let's see if there's any other questions here. It looks like that is the only question for today. So I will leave the call today by saying I appreciate you joining me. This will be a monthly Facebook Live. Next month, please join me when we're going to talk about now I'm pre-approved. What do I do next? And if you have some future ideas you'd like me to discuss, please text me, call me, email me anytime. My phone number at the office is 402-602-5362. You can reach me in my cell at 402-512-0041. Thanks again for watching. Have a great day.